Alright, data recording already? Okay. Alright, so your 16 minutes starts now.
When there is a risk, there is an actual opportunity. Good morning, Mr. Kenny, and to my fellow classmates. My name is Edison. Here's my group member, San Yuan, Eunice, and Ziyu. We are for Group 3. The topic of our presentation today is unlocking investment opportunities and actuarial risk management. The objective of our presentation today is to explore the common types of investment in which the company may utilize and how does the knowledge we have learned from actuarial science is able to minimize the risk of investment so that we're able to minimize the potential losses and maximize the profit. You might be wondering how actuarial science and investment are related. Well, nowadays, most companies have diversified business models. As a result, in order for them to sustain and achieve long-term growth, they need to have diversified investment portfolio. This will prevent them from falling behind or outperforming as compared to their competitors. Unfortunately, there is always risk involved with investing. Therefore, having a comprehension of actuarial science helps in developing a profitable investment plan that also avoid unnecessary potential losses. Here is a question for all of you. Have you wondered what actuarial science is? Well, actuarial science, also known as actuarial studies, is the discipline of applying mathematics and statistics in assessing and addressing the list of uncertain events, particularly in finance field. Investment is an action in which the company will invest their money or fund into one or more assets to generate return in future. However, there is always risk involved with investing. This is known as investment risk. Investment risks are the possibility of actual returns earned by investment will be different from what was estimated. For example, in probability, we have learned about the way is a way in which to predict the possibility of a certain event will happen in future. In statistics, we use the data we have collected to make inference and conclusion about certain events. Last but not least, in business finance, we deliver skills in financial planning, financial reporting, and investment analysis. Here are some of the applications of actuarial science nowadays. For example, banking and finance sector, pension, investment, and life insurance. Next, I will pass it to Sanya to continue our presentation.
Good morning, everyone. My name is Shan-Yuan. I'll continue the presentation from here. If we ever have the chance to invest, it's obviously we want to invest in something that benefits us. This action is called investment. Today, we are focusing on the investment decision made by companies. The purpose of company investing are to raise the capital or generate higher return in the future. The common types of investment used by company are bonds and stocks. However, there are some differences between them. Let's look at what differences are between them. Firstly, the bonds are debt security while the stocks are equity security. If a company decides to issue bonds, it's essentially for them to borrowing money from the investor and pay them with interest over a specific period of time. It's usually annually or semi-annually. It's also known as coupon payment and pay them principal amount at maturity. For instance, the US government may borrow money from the investor to make US Treasury bonds a better and safer investment. Another example would be a well-known company, which is Apple, which enable them to obtain money for a range of objectives such as expansion and R&D. However, bonds are usually safer than stock because in the events of bankruptcy, the bonds holder get payment before the shareholders. In contrast, stocks are equity security. When a company issuing stocks, it indicates the company is selling an ownership to investor in exchange of money. It will also dilute the existing ownership of the It will also dilute the ownership of the existing shareholder, as in the new investor will become the shareholder of the issuing company. For example of Apple again and Amazon, the investor of the company will get dividends when the stock value of the company rises, and also have the right to participate in the decision making of the company. Since their profits are based on the performance of the company and also the market movement, we often say that bonds are safer than the stocks. Unfortunately, investment failure is quite common nowadays. It generally teaches us the important lessons about the difficulties involved in financial decision making as well as asset management. Let's look at one of the real life examples in investment failure. Sean Quinn, the former billionaire, declared bankruptcy after the high-stake investment in Agro-Irish Bank. The bank collapse was largely due to the property-related loan and also risky of the lending property practices. And the investment failure was result massive in Quinn's Group and a debt of nearly 2.9 billion euros to Agro-Irish Bank. The involvement of an actuary could have prevented this catastrophic investment disaster, or at least reduced the losses. Next, I will pass to Eunice to talk more about investment risk and the role of actuarial analysis.
Good morning, Mr. Kenny and my fellow classmates. My name is Eunice. I will continue our presentation from here. As mentioned earlier, companies make investments so that they can sustain and grow in the long run. Unfortunately, investments come with risk, and these risks have large impacts on the overall performance of companies. They expose companies to the risk of potential losses and, in the worst case scenario, bankruptcy. Here are some examples of investment risk, which are credit risk, interest rate risk, and currency risk. Firstly, credit risk, also known as default risk, occurs when the issuer of the bond is unable to pay interest payments and principal amount to investors as promised as a result of financial difficulties and insufficient cash flows. Moreover, a company may expose itself to interest rate risk. The value of an asset such as bond fluctuates due to a change of interest rate. When interest rate rises, the price of the bond falls, and vice versa. This implies that interest rate and bond prices have an inverse relationship. Last but not least, a company may expose itself to currency risk, which is also called as exchange risk. It is the possibility of losing money upon investments made in foreign countries as a result of changes in exchange rates. In 2015, a company called Procter & Gamble, which is an American multinational consumer goods corporation, faced significant challenges due to currency devaluations affecting its financial performance. The company reported losses totaling 415 million in the December quarter and 615 million in the fiscal year foreign exchange losses, causing a 1.4 billion product reduction due to currency devaluations. It is one of the most significant currency fiscal year impact the company has ever incurred. Therefore, here is an opportunity for actuaries to step in to minimize the investment risk by using actuarial knowledge. What can you conclude on actuarial science graduates do in the investment industry? Well, actuarial science graduates can become investment analysts such as investment actuaries and actuarial analysts which mainly focus on investment analysis. Their responsibilities are to evaluate and manage the financial risk associated with investment choices. They work for insurance companies, pension funds, and other financial institutions, helping them in making investment decisions. It is important so that companies' long-term financial goals align with their aims. Apart from that, investment analysts also evaluate the risk and returns of various investment choices and also manage investment portfolios. They use various tools and the data they have collected to predict future investment performance and ensure financial commitments are met. Next, I will pass to Zhi to share the solutions of minimizing the investment risk.
Good morning, Mr. Kenny and my fellow friends. My name is Zhi. Let's dive into the applications of actuarial science to mitigate the investment risk that we mentioned earlier. We will explore three key areas, which are structuring and valuing derivative, tail risk modeling, and the credit risk management. Firstly, to assess the risk and returns of different investment options, actuaries are required to conduct pricing. This means actuaries will calculate the theoretical values of each derivative based on their future cash flow or dividend payments, so that they can invest at the proper time with a reasonable price. Let me introduce you one of the most important pricing models in the actuarial field, the Black-Scholes models. And here is the general formulas of it. So, what makes this pricing model so widely accepted and used in the actuarial industries? This is because Black-Scholes models takes into the considerations of interest rate risk and the price volatility, which allows the users to generate a streamlined pricing. Moving on to the second applications of actuarial science, the tail risk modeling. Tail risk model states that there is an event which has a rare chance to happen, and when it happens, the impact on the portfolio will be extremely large. One perfect example would be COVID-19, and we can use the tail risk models to estimate the gains and losses of an investment. You might now wonder what is the meaning of this. So let me show you the graph of the tail risk models. As you can see, the fat tail distributions, or what we call the tail risk distribution, is 3 standard deviations down from the current price. And the extreme areas after the intersection points are gains and losses respectively. We can say that tail risk models is essential to highlight the potential loss that could affect the investors, financial institutions, or the entire financial markets. Therefore, tail risk models provide accurate information that helps the actuaries for hedging purpose. The last applications of actuarial science will be the credit risk management. In investments, actuaries are concerned with the probabilities of default of a business and the expected loss of an investment. As usual, I will introduce you 3 crucial components in calculating the expected loss, which are the probabilities of default, loss given default, and the exposure at default. The expected loss is the product of these 3 components. To give you a better understanding, imagine today you invest in 6 kettles and you only get 2. In this case, the exposure at default is the outstanding amounts of kettles that you don't manage to get. In this case, which is 4. Now, to compute the loss given default, we will take 1 minus the recovery rate. In this context, recovery rate means the probabilities of you getting back those 4 kettles. For example purpose, we will assume it to be 25%. Lastly, the probabilities of default is simply 1 because it already happens. So, if you multiply these 3 components together, you will get the expected loss. All these information will help the actuaries to prioritize and choose the types of investment that aligns with their company risk tolerance and financial goals. That ends my part. I will now pass it back to Edison to conclude the presentation.
In conclusion, actuarials play a significant role in minimizing the investment risk. Companies have different ways and objectives of doing investment. However, companies may expose to various risk investment due to the investment they make. Therefore, this gives an actually an opportunity to step inside to mitigate those investment risks. We hope you all enjoy our presentation today. Thank you for listening.
忘记了。